Welcome to Analyzing Finance with Nick, and in this video I'm going to talk about why hedge funds blow up or fail. And there are several ways this can happen, but there are generally three reasons why a hedge fund would fail. The first one is the most dramatic, and that is really just poor risk management and using too much leverage. An example of this would be what happened recently with Archegos, where it was a family office technically, but he levered his capital 5-1, and some of the stocks he had had big drawdowns on news of a secondary, and as a result, this portfolio fell more than 20%, and since it's 5-1 leverage, it wiped out the entire fund. A lot of people, hedge funds, feel like they need to chase returns and get big numbers, and the way to do that is leverage, but leverage is a two-way sword. It works great on the way up, magnifying returns, but on the way down, it eats into your capital a lot faster than if you were unlevered. And the other mistake is a lot of assets are perceived to be less volatile than they actually are, which I'll get into the second reason for more on that. And so therefore people feel comfortable leveraging up in something that they probably shouldn't, because they think that the downside risk is not nearly as big. So basically these things tend to struggle and doubt. These funds struggle when the market turns down or volatility rises, and they get taken out. Another example really would be, in terms of this, is what happened to a certain degree with long-term capital management, who had a lot of leverage on various emerging market bonds, where their computer model said they couldn't move past a certain amount on one side, and they did when Russia defaulted, and the fund blew up. These are the ones you hear about most in the news because they're big and glamorous. It's not really glamorous, but infamous, and also often have systemic effects in other assets, because these funds tend not to be taken down by one of their or two of their investments going bad, so they have to sell the remainder of their portfolio, and therefore it hurts the rest of the market through having to sell a lot of the rest of their portfolio, and also it creates opportunities for otherwise good companies or good asset classes that get hit by forced selling due to liquidation of the fund. The second risk, which is similar to the first one in leverage, because leverage is an indirect way of expressing the same idea, is selling volatility at too low of a price. This is a fund, optionseller.com, failed because of this when the VIX spike a few years ago. A lot of funds were selling like these vol strategies, like the XIV ETF, and a lot of systematic vol selling hedge funds, and then they blew up when volatility spiked in February 2018. The VIX doubled, and as a result, the short VIX ETF basically collapsed. It lost over 90% of its value. Another example that happened was 2015, I believe, in Everest Capital, which is a multi-billion Florida-based hedge fund which sold volatility on the Swiss franc, which they thought wouldn't move because of the peg to the euro, and they believed, the Swiss government would never break the peg with the euro. And one day it just was, even though it was relatively unsustainable for the Swiss to constantly devalue their currency to catch down to a euro, and one day the Swiss central bank just cried uncle and said, look, we're not going to maintain this peg anymore, and we're going to let it free float, and the Swiss franc rallied 20% in one day. And Everest, which sold, I don't know the exact amount, but they sold the puts for a pittance and lost hundreds of millions of dollars on that trade. And that's generally, you don't want to sell volatility and something that's pricing in zero volatility, even if you think the probability is next to nothing, because even with a 1% chance you're wrong, the damage from you're going to get in terms of negative gamma from selling that vol position outweighs the tiny benefits of this. This is generally, this goes back to what I talked about in the iceberg of finance with Taleb's Turkey. Selling vol is the best performing strategy in terms of Sharpe ratio and risk metrics as long as volatility remains low. But then when it explodes, you basically, what happens is you lose all of those gains over the year. So say if you sell S&P volatility, for example, for 5%, and that works 20 months in a row, and then the 1 month the S&P has a big move down, you wipes out all the gains. That's, or even more, it usually leads to zero. I don't think the S&P is the best example, but you get my general idea. And a lot of hedge fund failures are caused by either directly selling vol through selling options in something that the volatility is too low in, or they're not anticipating the right probability of an adverse event, or through indirectly selling volatility by, say, for example, levering up a perceived safe asset, or having too much concentration in a high beta sector, or risk, or something with a lot of implicit risks that are known but nobody thinks will actually trigger. So those are implicit ways of selling volatility, even if you're not directly trading the options market. I think I'll do a future video about how most trades really kind of translate to either a long vol or an implicit short vol position. And then the last one is simply just not being able to get off the ground. I mean, there's a lot of costs to running a hedge fund, and its returns can, in terms of the way investors feel about a particular fund, are very path dependent. So if you start off with, say, a bad year, it's going to be harder to raise money, and therefore it may not make sense to stay in business. Or if you do have a couple bad years in a row, or just happen to have a year where you just don't perform as well as the rest, you get maybe a bunch of redemptions, and that compounds and takes you out. Those are more slow grind. But yeah, or that generally just the fact that it's just that, especially that size is more valued in longevity than actual hard returns in a lot of this business, and that fees can be considered high, and in a world of low-cost ETFs, investors are less willing to pay for those fees, especially if you have a era which is a pretty strong bull market like we do right now, where holding the index will get most, if not more, returns than the hedge funds do. You could see how a hedge fund just may not be able to stay in business just because the costs outweigh the benefits for the remaining investors and for the GP themselves. That concludes this video. Let me know if you have any questions or feedback, and good luck out there in the markets.